Joining us now to discuss the NAAMSA's new vehicle sales report for June is Sydney Soundy. He's Managing Executive of Vehicle and Asset Finance over at Absa. Thanks so much, Sydney, for joining us today.
Thank you for inviting me.
We've seen some growth filter through here. Total industry vehicle sales up 12.6% and new vehicle sales up 16.2% year on year. In line with your expectations?
It is fairly in line with the expectations. As we said in the last few months, we think that by the end of this year we shall see growth of between 10 and 15%, depending on where you stand in the conservative or optimistic spectrum.
Well, taking a look at things, I mean, we've got obviously to look at passenger versus commercial vehicles at this stage. What kind of trend are you noticing in those respects?
Passenger vehicles are still very strong. We see light commercials struggling a bit. And then we also see a strong performance from the medium, heavy, as well as buses sector of the market. So that may be an indication that, in fact, from an investment point of view in large corporates, as well as perhaps a replacement of vehicles, that the necessity becomes a reality, and as such, there's a replacement of those vehicles in those sectors.
On the consumer side of things, though, and this pertaining to the passenger vehicles, does it then necessarily mean that we're seeing consumers a little bit more open to buying new vehicles and less worried about their state of finances moving forward?
I think we're seeing that, although, like we've said, I think it will taper down as we go towards the end of the year. But we are seeing a very active market in the consumer space. And as we've indicated, the consumer side of the business has actually been the bigger driver of the sales as we see them so far.
What are some of the contributing factors that we have to take into consideration here? Because when you're looking at the consumer, it's still a consumer that is under pressure with high inflation rates. I was chatting to Earvolt a little earlier about house prices, and that a common factor, that we've got to look at. We've got fuel prices having increased, municipal rates increased, a debt to disposable income ratio still sitting staggeringly high. So why are we seeing this turnaround?
I think the issues that you've highlighted give an indication of the multifaceted nature of how you should be analyzing these results. So I think from the perspective of the consumer, if you look at the vehicle price inflation, as well as the general CPI, it has really stayed within the range of the Reserve Bank targets. Then there's the issue of interest rates that they've been low for some time now in the previous year and this year. So from a disposable income perspective, there hasn't been a pressure put so far on the consumer. And that's why you're seeing that much of activity. Like you've rightfully indicated, I think in the months to come, we'll see that impact beginning to take its course on the consumer.
The good thing is that we're not seeing that price inflation filtered through, and that's something consumers have to be smiling about. Of course, one of the factors to consider there is that we've seen a stronger rand, and one can only assume that that is the only contributing factor.
That will be a contributor, particularly if you look at the imported vehicles. The imported vehicles are doing well since the beginning of the year, and in fact even in the previous year we've seen good sales volumes coming from importers.
Having said that, the stronger rand does present a double-edged sword because we've got our export market to look at as well. So how are we faring in that regard?
So export is also doing well. If you look at year to date so far, 24% increase from last year. Which is an indication of good activity in that environment. So despite the rand issue that you've raised, the fact that there has been contracts that the local manufacturers still need to meet overseas, that has given sufficient boost to the export market.
Let's take a look at used versus new car sales, because we know that that gap between the two has been, closing incrementally over the recent past, where you've got manufacturers creating newer and cheaper vehicles, and you've got consumers holding on to their used vehicles in the hope that that used car market is going to improve.
So we've seen a stabilization of the ratio there. So between 1.7 of used vehicles to one new, that's the level of financing that is currently happening. And that average is expected to remain pretty much the same because like I've indicated, as far as the price of new vehicles is concerned, that has remained fairly steady. So we don't see that there will be a shift quite a lot towards the used car market, but it will remain fairly much stable in the few months to come.
We've got the South African consumer also making more use of the kind of agreements where we've got applications for longer term periods to pay down debt on the rise, right?
It is. So in terms of the term that is being applied for, we see quite a lot of customers applying for more than 60 months now.
Mm-hmm.
So whereas in the past few years, 60 months used to be the general norm as far as the term applications is concerned for the period, going into this year and the next years, we see that quite a lot of consumers will be applying for terms that are longer than 60 months, so towards 72 months.
And terms at a fixed rate?
Fixed rates will remain pretty much the same for now. But as you know, there are expectations, some as early as towards the end of this year, but others like Absa expecting that there should be changes in interest rates early in the new year. So once we see those changes in interest rates, the demand for fixed rates may change somewhat. But at this stage, there's still good demand for fixed rates.